Hi, we are back. We are finishing up ratios from chapter 15. So this is class 41, video B if you're in the Monday, Wednesday, Friday class, and it is class 27, video D if you're in Tuesday, Thursday class. Last few ratios, last video of the semester. So let's talk about evaluating the ability to pay long-term debt. So far in this chapter we've talked about horizontal analysis, vertical analysis, trend and benchmarking type analyses. We got started last video talking about ratios, and we talked about ratios that look at how well companies can cover their current liabilities and how well they sell their product. Now we're going to start out talking about the ability to pay long-term debts. Now, most businesses do have some long-term debt, not all, but when they do, there's some ratios that can help us think about how well they're covering that. The ratios discussed so far yield insight into current assets and current liabilities. They help us measure ability to sell merchandise inventory, collect receivables, and pay current liabilities. Most businesses also have long-term debt. Three key indicators of a business ability to pay long-term liabilities are the debt ratio, the debt to equity ratio, and the times interest earned ratio. So let's take a peek real quick at the debt ratio. So you're going to need your balance sheet, and you're going to have to look at that to figure out the debt ratio. The debt ratio shows the proportion of assets financed with debt. So the debt ratio is super simple, total liabilities divided by total assets. So if the debt ratio is 100%, then all assets are financed with debt. A debt ratio of 50% means half the assets are financed with debt. The other half are financed by the owners using equity. All right. The higher the debt ratio, the higher the company's financial risk. The debt ratio can be used to evaluate a business's ability to pay its debts. So obviously, higher debt means the company owes money to outside of the company, and if they can't make those payments, those people outside the company can cause issues, right? And also, when you think about it, there can be interest expense associated with having a lot of debt. So you're kind of have an increased expense associated with paying interest. All right, another measurement of how much companies owe is the debt to equity. So we talked about debt ratio, which is liabilities divided by assets. Now we're going to look at liabilities compared to equity. So you take the debt to equity, just like it sounds, debt divided by equity. So it measures the proportion of liabilities relative to equity. Debt to equity ratio equals total liabilities divided by total equity. Thus, the ratio measures financial leverage, and you'll hear about this in future classes, especially finance classes. If the debt to equity ratio is greater than 1, then the company is financing more assets with debt than with equity. If the ratio is less than 1, then the company is financing more assets with equity than with debt. Right? So if 1 or greater, like for our company, you see on 2018 it's 1.21 and 1.01. I mean, just by looking at that, you can see, okay, well, if the top line is liabilities and it's bigger than the bottom, clearly you've got more debt than you do equity. It's got greater financial risk, but again, if you think about it, using debt lets you, buy more stuff, buy more inventory, buy more plant assets, and therefore make maybe more money than you can if you just took it out of your own pockets. All right, next, times interest earned ratio. Right, so you have to cover your interest expense. I talked about that a little bit ago. Time interest earned ratio evaluates the ability to pay the interest expense. So the more debt you have, if you have more debt than equity, right, you're going to have to cover that interest. So you have to think about that. So times interest earned ratio equals net income plus income tax expense plus interest expense, all right, divided by interest expense. So it tells you how well you're covering it. This ratio measures the number of times earnings before interest and taxes can cover interest expense. They call that earnings before interest and taxes, we call it EBIT. Can cover interest expense. This ratio is also called the interest coverage ratio. A high times interest earned ratio indicates a business ease in paying interest expense. A low ratio suggests difficulty. So for our example, in 2018, they had 4.3 times interest earned. In 2017, they had 4.07 times interest earned. The industry average is 7.8, so they're below industry average. So that means they're having a little harder time covering interest expense than others in the industry would. But they're covering it. All right, so now that we've considered long-term liabilities, there's a few other ratios that people use, especially when they're from outside the company and they're looking at the company's financial statements, trying to decide, should I invest in it? And they want to know, well, is this company profitable? And if I invest in it, will I get some profit too? So, the fundamental goal of a business is to earn profit. Ratios that measure profitability are often reported in the business press. 5 profitability ratios are discussed in this chapter: profit margin, rate of return on assets, asset turnover, rate of return on equity, and earnings per share. So these are things that frequently investors are going to care about. So let's talk first about profit margin ratio. Profit margin ratio shows how much net income a business earns on every dollar of sales. So whenever I make a sale, how much of that is going to become my net income? All right, profit margin ratio equals net income divided by net sales. This ratio focuses on profitability. The higher the profit margin, the more sales dollars end up as profit. So in our example, our company has in 2017 a 3.2 profit margin, in 2018 a 5.6 profit margin. So the profit margin is growing. So they get out every time they make a sale, they get more profit from that sale, and it's better than industry average. Industry average is only 1.7%, which that seems pretty low, not real profitable. So great, we're doing better in that ratio. Rate of return on total assets. So you've got some assets in the company. The point is to use them to make money. So how well do you do that? Well, the rate of return on total assets is a ratio that measures the success a company has in using its assets to earn income. Rate of return on total assets equals net income plus interest expense divided by average total assets. There are 2 ways that a company can finance its assets: debt, by borrowing, and equity. A company receives cash. Stockholders invest and hope to receive a return. So when you're looking at the return, you just look at net income plus you add the interest expense back in, because they don't necessarily have to finance with that interest. Earnings before interest divided by the assets. And that tells you how well they're using the assets. Asset turnover ratio, also telling you something about how well they're using the assets. It measures the amount of net sales generated for each average dollar of total assets. So you have to calculate your average total assets, which is just last year's assets plus this year's assets divided by 2. So you need 2 years of financial statements, and you just take the average, which if you have 2 years, then that's divided by 2, and you divide that into net sales. So net sales divided by average total assets is asset turnover ratios. Generally, companies with high gross profit will have low asset turnover ratios. Companies with low gross profit will have high asset turnover ratios. So there you go, and that is true for this company. 1.2 times and 3.52 times is the industry average. Rate of return on common stockholders' equity. So rate of return on common stockholders' equity shows the relationship between net income available to stockholders and their average common equity invested in the company. So how much income could be paid out, right, as a percentage? How are they doing on their stock? So the rate of return on common stockholders' equity equals net income minus preferred dividends, because preferred dividends that get paid out aren't available to common stockholders. So net income minus preferred dividends divided by average common stockholders' equity. This ratio shows how much income is earned for each dollar invested by the common stockholder. So in our example, industry average 10.5. In our example for 2018, it's 14.2%, so they are better than the industry average. Let's let's use the figures of Smart Touch Learning's rate of return on stockholders' equity, which is higher than its rate of return on total assets. This difference results from borrowing at one rate, say 8%, and investing at a higher rate, such as the firm's 14.2% return on equity. This practice is called trading on the equity or using leverage. Companies that finance operations with debt are said to leverage their position. Trading on the equity is earning more income on borrowed money than the related interest expense, thereby increasing the earnings for the owners of the business. So when you leverage, you get more return. The downside is you got more debt, you got more interest expense, you got more risk of not being able to pay that back. EPS, earnings per share, perhaps the most widely quoted of all financial statistics. EPS is the only ratio that must appear on the financial statements. Earnings per share reports the amount of net income for each share of the company's outstanding common stock. So that's why when we learned about common stock, we talked about, issuing stock and keeping track of that. Earnings per share is the amount of a company's net income or loss for each share of its outstanding common stock. So to calculate that, you take net income minus preferred dividends. Again, this is on common stock, so you exclude that stuff that's not available. Divide it by the weighted average number of common shares outstanding. So this could go up and down during the year. Common shares outstanding is what you've issued, but if you have purchased back any treasury stock during the year, you have to subtract that out. We don't really learn about that in this class, but just know there's this number, weighted average common shares, and you divide that into the net income. And you come up with this EPS, earnings per share. And it's a few dollars, depending on how many shares are outstanding. FASB does require that earnings per share appear on the income statement. Corporations report a separate EPS for each element of income. So you'll see this. This is something you could actually see on a financial statement, is this EPS. So, when evaluating stock as an investment, investors purchase stock to earn a return, right? So if you go out on the stock market and you buy some shares in a company, you want to make more money. This return consists of two parts. Gains or losses from selling the stock at a price above or below purchase price, right? So you want to buy low and sell high, right? Blash, buy low and sell high. And also, those stocks pay dividends, as we've learned this semester. If you're a stockholder, you might get some cash out of the company quarterly, semi-annually, annually. Just from time to time, they'll pay dividends. So, there's this PE ratio. The price-earnings ratio is the ratio of the market price of a share of common stock to the company's EPS, right? So, if I'm going to invest in your stock, it also pertains to how much I'm going to have to pay for your stock, right? So if I go out on the stock market and buy your stock, I'm going to pay a market price. How much am I going to get back? So the PE ratio shows the market price of $1 of earnings. So the price-earnings ratio is the ratio of market price of a common share. So this is obviously going to change every day because the market price changes every day. It measures the value that the stock market places on $1 of a company's earnings. So PE ratio is equal to market price per share divided by earnings per share. So in this ratio, abbreviated PE ratio appears in many print and online stock listings and measures the value that the stock market places on average. So this is something like if you were to look up a company, like you were going to look up stock prices, a lot of times next to stock prices, they'll just have the PE ratio there. And in our example for 2018, a PE ratio, that stock at the time this was done, which is probably December 31st, it was selling for $60 per share. Their EPS was $4.8 per share, so that's an EPS of 12.5. The industry average is 17.79, so we're slightly lower than that, so they don't value us as quite as much as they do other companies. Dividend yield. The dividend yield measures the percentage of a stock market's value that is returned annually as dividends. So every year a company pays out, not every year, but from time to time companies pay out dividends to the stockholders. And to look at this, you take the annual dividend per share that's actually paid out, not that EPS, that's net income per share. The dividend is the actually paid out dividend. So you take annual dividends per share, divide it by the market price, and it tells you what the dividend yield is, so what you're getting back in terms of dividends. Dividend payout measures earnings paid annually to shareholders as cash dividends. So that's dividends per share divided by earnings per share. Right? So again, it's the ratio of dividends declared that you actually got paid per common share relative to the earnings per share. This ratio measures the percentage of earnings paid to common shareholders as cash dividends. And so that's about the total ratios. There's plenty of ratios. There's as many ratios as there are numbers on financial statements, but those are basically the main ones people use. Don't worry, on the final, I'll give you a sheet of paper with the common ratios on it, so you don't have to memorize all the ratios. For the CPA exam, you have to memorize them, but not for this one. Let's talk about a few red flags. Analysts looking for red flags in financial statements may signal financial trouble. Recent accounting scandals highlight the importance of watching for these red flags. The following conditions may reveal a company is too risky. Movement of sales, merchandise inventory, and receivable. Sales, merchandise inventory, and receivables generally move together. The more you sell, the higher your receivable, the lower your inventory becomes. Increased sales lead to higher receivables, may require more merchandise. Unexpected or inconsistent movements among sales, merchandise inventory, and receivables make the financial statements look suspect. Earnings problems. Most companies cannot survive losses year after year. Decreased cash flow. Cash flow validates net income. Is net cash flow from operating activities consistently lower than net income? If so, the company is in trouble. Too much debt. If the debt ratio is too high, the company may be able to pay its debts. Inability to collect receivables. Are days sales and receivables growing faster than for competitors? If so, a cash shortage may be looming. Buildup of merchandise inventories. Is inventory turnover too slow? If so, the company may be unable to sell goods, or it may be overstating merchandise inventory. All right, so if you'll check out Exhibit 15.8, there's a summary of all the ratios used, and they're categorized by what they do, right? The ability to pay current liabilities, which is the working capital, the current ratio, and the cash ratio. The evaluating merchandise inventory and receivables. So we've learned all these. They're summarized in this table, and I'm going to give you this table for the final, so that way you don't have to memorize everything. So, but you will need to understand, kind of how to compute them and what that means, right? So compared to, say, an inventory average, are they doing good or bad? So learn those ratios, learn how to compute them, but no, you don't have to memorize the formulas. Okay, well, good luck. I hope you do great on the final.